SHG, QQQM, and XLK are three of the more popular growth funds out there. And while they might look similar from the outside, each one is built on a completely different set of rules. And in this video, I'm breaking down each one of these funds and which one I'd actually invest in. This video is for educational purposes only. This is not financial advice, and I'm not a financial advisor. All investments carry risks, so always be sure to do your own research. Let's start with the strategies of these ETFs to see how and why they hold the stocks they do. The first ETF is SCHG, the Schwab US Large Cap Growth ETF. SCHG tracks the Dow Jones US Large Cap Growth Total Stock Market Index, which is made up of large cap growth companies. These are companies that are expected to grow earnings and revenues faster than average. And the growth stocks that this index chooses is based on 6 different measures. 2 projected, which are projected price to earnings ratio and projected earnings growth, 2 current, which is price to book ratio and dividend yield, and then 2 historical, which is trailing revenue growth and trailing earnings growth. The next ETF is QQQM, the Invesco Nasdaq 100 ETF. And this ETF tracks the performance of the Nasdaq 100 index, which includes the largest 100 non-financial companies and the Nasdaq index. And this index has a few requirements for the stocks that it holds. The company must be listed on a Nasdaq exchange, and it must be classified as a non-financial company. It also has to have a 3-month average daily traded value of at least $5 million, and it must have been listed on the market for at least 3 full months. And there's a few other rules, along with the new update for fast entry that can speed up a time that the stock can be added to the index after only 15 days. Third up, we have XLK, the Technology Select Sector Spider ETF. This fund tracks the Technology Select Sector Index, which focuses on 2 things. Companies have to be in the S&P 500, and they must be labeled by GICS as an information technology stock. Now, this GICS classification is managed by a committee, and they decide what qualifies as technology. And this index covers different industries like semiconductors and semiconductor equipment, software, hardware, communication equipment, IT services, and more, which means it's solely focused on the technology sector. So the strategy and approach of how these ETFs choose their stocks differs by quite a bit. SCHG measures and filters metrics, QQQM looks at size, trading, and listings, while XLK is focused on classification and index. And the strategies of these ETFs leaves you with 3 very different portfolios, so let's get into the stocks and sectors that actually make up these funds. With SCHG, you're getting a total of 197 holdings, with top holdings in Nvidia, Apple, Microsoft, Amazon, and other big names that I'm sure you've heard of. This top 10 makes up just over half the weight of the portfolio, so it leans pretty heavily into these names. For the sector exposure, technology is the biggest, then communication, consumer discretionary, and a few others. These top 3 sectors are mostly because of those top stocks, especially technology. Moving over to QQQM, this fund has 104 holdings in its portfolio. And the top holdings look very similar to SHG, with Nvidia, Microsoft, and the others, with the only difference as of now being Micron. The stock weights are a little smaller as well, since these top stocks make up a little under half of the portfolio. On the sector side, technology makes up a big majority, followed up by consumer discretionary, and the rest is spread across other sectors. Last up is XLK, and this fund has only about 73 holdings, and it has companies like Nvidia, Microsoft, Broadcom, AMD, and Intel. And since this fund only focuses on tech, the industries it's mostly exposed to are semiconductors and semiconductor equipment, software, and tech hardware and storage. And you're not going to see stocks like Meta, Amazon, Google, or even Tesla in this fund, since the GICS classification doesn't consider them as technology stocks. But when it comes to diversification for a high growth fund, SCHG has the edge here. It holds more companies, and it has a decent amount of exposure to other sectors outside of technology. QQQM also gives you exposure to other sectors, but these days it leans heavily into technology. And XLK is focused purely on technology, and it's heavy on chip stocks, so diversification is out the window on this one. Now that you understand the makeup of these ETFs, let's see how they differ when it comes to risk and volatility. High growth ETFs can really boost your portfolio, but the truth is they also come with much more volatility and risk. If you don't know already, beta is a measure of the risk or volatility of an investment compared to the market as a whole. And the market standard is the S&P 500, which has a beta of 1. So a beta less than 1 is likely less volatile and less risky, while higher than 1 is more volatile and more risky. But let's take a look at the beta for these funds over the last 5 years. SCHG's beta is 1.19, QQQM has a beta of 1.22, and XLK's beta for the last 5 years is 1.34. SCHG and QQQM are pretty close to each other, while XLK had more volatility than the others. And volatility plays into the drawdowns that an ETF experienced in the past, as well as price movements and potential drawdowns in the future. But let's compare the 3 largest drawdowns over the last 10 years for these ETFs. And also, since QQQM is only about 6 years old, we're going to use QQQ instead, which is basically the same fund. The first and biggest drawdowns for all of these ETFs was the bear market in 2022, where SCHG was down 31.8%, QQQM was down 32.5%, and XLK was down 31.2%. After that, we had the COVID crash in 2020, which was pretty dramatic, along with the downturn in late 2018. The gap between the funds isn't that big at all, and oddly enough, each ETF had 1 year where it dropped more than the others. And if you average them out, they're all pretty close to each other. So what does this really highlight for us? Well, a fund that's purely focused on technology didn't fall as hard as a fund that has half of that exposure across different time periods. And it goes to show when large cap growth gets hit hard, it all falls together. There isn't much protection, and having a pure tech focus doesn't make much of a noticeable difference here. And this is why I think that these funds are tied when it comes to their overall risk and volatility. While the risk and volatility was pretty closely aligned between these funds, when it comes to performance, it's a much different story. When it comes to performance, SCHG's had 5-year annual returns of 13.1%, with annual returns of 18.5% over the last 10 years. QQQM has had 5-year annual returns of 14.3%, and for the 10-year returns, we'll use the older QQQ, which did 20.8% annually. As for XLK, this fund left them behind with 5-year annual returns of 18.8%, and 10-year returns of 24.3%. Keep in mind, since QQQM was only created in 2020, I'm using the data from the older QQQ fund that tracks the same exact index for that 10-year time frame. Also, when it comes to the performance, the expense ratios of these funds are baked into those numbers. Where SCHG has an expense ratio of 0.04%, QQQM at 0.15%, and XLK at 0.08%. These are very small differences, and they barely have an impact on the performance. Now, I want to give you an idea of how that performance looks when money is involved. If you would have put $10,000 into these funds 10 years ago, SCHG would have grown to $54,900, QQQ would be at $66,000, and XLK would have turned into $88,000. The difference in performance can really add up over a long time period. When it comes to performance, there's no doubt that XLK takes the win when it comes to the shorter and longer term. Little did we know 10 years ago that technology like semiconductors and hardware were going to have one of the best runs that the market has ever seen. And even though growth funds had amazing returns, XLK was able to take a bigger chunk of it. But now let's get into which of these 3 ETFs that I'd actually hold. Now, if I personally could only put money into one of these ETFs, then I'd have to choose SCHG. It's the only ETF out of the group that chooses stocks based on growth metrics, and it spreads your money into more areas than just technology. But I can't ignore the big gap to point out, which is the performance. A tech-focused fund like XLK benefited from the explosive growth in semiconductors, hardware, and software. And while there's some overlap of stocks across all these ETFs, that focused exposure really gives XLK the edge. And it could potentially stay that way for the near future with all the heavy spending and development in AI. Now, I personally think the tech sector has a lot of potential, but a good portion of my portfolio includes tech stocks like Nvidia, Microsoft, Broadcom, Palantir, and others, and adding a tech fund on top of that is a little bit of an overkill. But this doesn't take away from the fact that QQQM and XLK are great funds that have a lot of potential. And depending on your investing strategy, you don't only have to hold one of these ETFs. For example, you could split the growth portion of your portfolio between multiple funds, like having SCHG and XLK for the best of both worlds, even though there's some overlap. Just keep in mind that these ETFs are satellite positions that you can combine with a core ETF for a more well-rounded portfolio. If you're still not sure which growth ETF you like, I ranked 23 of the best high-growth ETFs in this video here, or you can check out this video here where I compare 2 popular growth funds, SBMO and QQQ. As always, I really appreciate you watching. Keep on investing, and I'll see you in the next one.